It's episode 169 of the Property Podcast. It's Rob B here with Rob D. And this week we're talking about one of those subjects that always gets debate going. We're going to look at, will property prices double in the next 10 years?
Yeah, this should be a really, really good episode. This is putting together some of the themes that we've been talking about over the last couple of weeks when we've been in more of our economics kind of mode. And also, really, it's a question that if you knew the answer to this, you'd know exactly what to do, wouldn't you? If property prices will double in the next 10 years, if it was as simple as the fact that they'd just double everywhere, you'd go and buy everything you could right now. But will they? How will you know? Well, we're going to go into all this stuff, look at what's happened in the past, look at what could happen in the future, and unpack this whole question. We've also got the resource of the week, of course, and a really interesting news story as well. But just quickly before we get into all that, it was meetup night last night as we're recording this. Rob, where were you?
I was in Maidstone. I've never been to Maidstone before, so that was cool in itself. And it was also the first ever Maidstone meetup as well, popping up everywhere, Rob. And well done to the hosts, Sultan and Christina. Great that they've got it off the ground. They only found the Property Hub literally a few weeks, maybe months ago, but taking loads of action, really throwing themselves into it. And I think because of that and because of the commitment to it, I think it's going to be a great group. But one of the things I really like, Rob, and we mentioned this before, is the local knowledge you can pick up. The people were talking about, the fast train lines into Kent and different areas they were looking at. They were mentioning Folkestone as an area to consider, Rochester as an area to consider, talking about the fundamentals, just that knowledge. My knowledge is very much based in the immediate southeast of London, Hertfordshire, definitely in the Midlands and the North all day long I could talk about. But Kent, not something I know loads about. So it was good to get that knowledge and understand what's happening in the areas. And I think that's a top tip, actually, for anybody who's looking at an area that they don't know and aren't sure of, but they want to start investing in. We get a lot of people in London now go, I want to look at Manchester or I want to look at Leeds. Go to the meetup there and meet the local experts. It will definitely accelerate your knowledge. Yeah,
I've said this to a few people now, and if I wanted to invest in Kent, then I would absolutely go over there. I think I'd fail at the first hurdle, so I don't know if I'd be able to find the meetup on a map, because my knowledge of that part of the world is so poor. But yeah, there is a lot going on down there. I've heard people mentioning various things, but I know very little about it. I'm sure the best place to get an education would be at a meetup like that one. I wasn't quite as adventurous. I went as far as about 10 minutes away from where I live to the King's Cross meetup. I was playing my lazy card. I've been around quite a bit, but I thought, no, let's stick close to home for this one. But it was another really great meetup. One of the funniest things that happened was that I was standing there talking to a guy who was 24 and he'd already started investing in property. I was like, I feel really old now. Doing really well to have started at 24. Then we got joined by someone who was 18 and had just started investing in property. So the 24-year-old I was talking to was like, I feel really old now. And I just kind of gave up and walked off at that point. It was just depressing, but brilliant. It was amazing it's always amazing to go and meet people who are all kind of, most people come from like a long day's work doing demanding jobs, and they were still kind of looking at doing something extra and pushing things forward. And the fact that you had people doing it at 18 is just unbelievable. So always inspiring to get out there and see what people are doing.
I can't even remember what I was doing at 18, but that's probably the reason why. It's probably because it wasn't good.
Yeah, exactly.
It definitely wasn't property investment.
Well, let's move swiftly on, but just say thank you so much to everyone who went out to Meetup, and a special, huge thank you to all our Meetup leaders. You can book for next month already. It's always the first Thursday of every month. If you go to thepropertyhub.net/meetups, you can see all of them, all 30 odd listed on there. Find your nearest and book. It's free. Okay, so our news story this week, thank you to Bjorn for sending this one in. It's from Merrin Somerset Webb from her column in the FT. And the headline of the article is that demand, not supply, is the property market's problem. So this is related to what we were talking about, supply and demand, a couple of weeks ago. And what she's basically saying is that rents are hardly rising. If supply were a problem, she's saying, then you'd expect rents to be rising as much as house prices. And she says that rather than it being on a supply side problem, you've got an excess of demand, which is being stoked by low interest rates and by help to buy and all that kind of thing. Now, Rob, we were talking about this before. You don't buy into this theory.
Yeah, this article got my back up, and most of her articles do, because I think she's quite clever. She writes stuff for reaction. It's just a load of nonsense. So first of all, I think she needs to go and listen to our supply and demand episode from a couple of weeks ago, because that really will put her on the right path. These are short-term things. This is what we warned against, about people saying, well, this economic thing could change, or that government policy could change, and the market could move. And it does. And she's not wrong. These things do affect short-term measures. So rents, demand, supply, government tweaks, first-time buyers, owner-occupiers dropping off, more owner-occupiers, whatever. It doesn't really matter. These are all short-term things. To take a few of her points, rent hasn't been rising, but let's see what happens now after the stamp duty changes and the tax changes, where not as many landlords will be piling in, and there's less properties out there for people to rent. Rent prices, because of supply and demand, over the coming years, I predict, will start to move up, and potentially even boom. But again, that's a short-term thing. Her other point about first-time buyers being heavy in the market, well, actually, you could actually argue the other and say supply is down, because the amount of transactions happening right now is historically quite low. So not only are the short-term points she's raising, I feel, are short-term, but actually I disagree with some of the short-term points that she makes in the first place. So I think, yeah, great, she's got some collar inches, great, we're talking about it, and that's a great thing about property. If you've got a strong opinion one way or another, you tend to have it debated. But I think that the main point here is that she's really missing is interest rates, first-time buyers, doesn't really matter. It's the long-term trend, and all it comes down to, and some people really miss out on the simplicity of this, is that if you don't have enough of something, and you have a lot of people who want it, over the long term, the prices will move up. That's why we featured the David Smith article, because he summed it up so nicely.
Brutal. I'm going to be a little bit more favourable because I'm a Merrin fan. Maybe I'm cutting her a bit more slack. But when I was reading this, I was thinking that, well, she's saying that there's too much demand, which seems like just another way of stating not enough supply. You're talking about the same thing, but just blaming it on one thing rather than the other. But you're effectively looking at the same issue. If we were building 250,000 houses a year, you probably wouldn't be having this conversation. But first of all, I think she's saying that she's coming at it from a slightly different point of view. Like we are always quite realistic about the fact that there will be ups and downs, but the trend will be up because of the supply and demand issue. And I think we were quite careful to say this when we're talking about it. It's like, we're not going to say prices are just going to go up forever. And I think she is warning off people who maybe haven't thought about it in that level of detail and just think, oh, I'm just going to buy this and watch it fly up. In fact, if lots of demand has been pulled into the market because of government policies and other things, then that demand could disappear, things could fall. That's not saying it's not going to pick back up again over the long term. And so I think it's the whole short-term, long-term distinction that might be the difference in what's being talked about here. Also, and we're going to talk about this later as well, I think when you don't look at things at a regional level, it can lead to lots of wrong conclusions. Because you could look at house prices in London, that tells you very little about house prices in Wales. And when you just take the UK average for something, you can miss a lot of what's actually happening. So there's loads of points in there. We've discussed it in brief. It's worth going and checking out the article. It'll be in the show notes. It's worth also going back and listening to our supply and demand episode, which really ties into this, a couple of weeks ago. Both of those things and everything else that we talk about in this episode will be in the show notes at thepropertyhub.net/next 10 years.
Rob, I know it's brutal, but I'm just excited about this episode. I think what we're going to discuss today, the title, kind of, yes or no, but it's not one of those episodes. We're actually going to dig deep.
Yeah, we really are going to dig deep. This was inspired by a blog post that I saw basically arguing that property prices weren't going to rise from where they are now. And I thought, that's quite interesting. Let's look into this. And it was just so kind of surface level and based on supposition that I was really disappointed by it and just thought, I'm not even going to mention it in this episode because it's barely worth mentioning. But it did make me think, well, let's look at this in proper detail then. We've covered this topic before, way back, but let's go back over that again, and then let's look at all the different factors in play and draw some conclusions from it. So hopefully, rather than just being a grabby title, we're going to really get into the detail of this and give you some interesting things to think about. So we're going to talk about, will house prices double in the next 10 years? But the reason why we're asking that precise question is because of what's happened in the past.
So as you can imagine, we've not waited to episode 169 to discuss this. we've covered it before. And if you go to episode 58, you'll be able to listen to an episode where we went, does property double every 10 years? And we looked at the data. Now, don't worry if you're thinking, well, there's a lot of links today. Go to thepropertyhub.net/next 10 years. That's next 10 years, and you'll be able to get all these links. But in that episode, we looked at the data, and we looked at the nationwide data because that's the longest stretch of data that we have, and that goes back to 1952, Q3 to be exact. And we looked at the data. What we discovered, we had a few assumptions before we recorded that show, and we talked about them. It's interesting what assumptions we have about these things. But the stats show us that property in the UK, so this is a UK average, has doubled every 9 years. Every 9 years on average. That's an average, okay? And that's a UK average. I'll explain why I'm emphasising those points in a minute. The longest period was 14 years, okay? So the longest time the average took to double was 14 years. And the shortest, believe it or not, was only 3 years, and that was in the 70s. Now, we did have high inflation, and again, we'll come back to a few of these things a bit later on. But 3 years, that's absolutely incredible to think that property prices doubled so quickly. Now, average, I mentioned that word and emphasised it, and it's important, and that's why we're doing this episode. Because while the longest period of 14 years was an average, there were clearly some areas that were a bit faster than 14 years and some areas that were a bit longer. And that's exactly the same with the average of 9 years and the shortest 3 years. These are averages. So there'll always be areas that perform better and there'll always be areas that perform worse than the average. And that's why you come up with the average in the first place. And that's why we're having this whole episode, because people will say, and I've heard it this week, well, I live in this part of the country and I've not seen property move at all in the last 10 years. So are they one of those areas that don't double at all, or are they just way off the average? So we have to look at why this is happening in the first place, though. If we understand that, then we can understand why this trend continues, at least on a UK average basis anyway.
Yeah, so why has this historic doubling happened? Well, two main reasons. The first of them being supply and demand. So we talked about it just a minute ago. We talked about it a couple of weeks ago as well, back in episode 167. So very simple. The population of the country is growing because of people living longer, because of more people coming here. At the same time, living patterns are changing. So people are living in smaller groups. And so the household size has gone down. Therefore, more demand, not enough supply. Go back and listen to episode 167 for more on that. Also, there's inflation. So house prices have gone up over time, but prices of everything go up over time when there's inflation. General prices of everything now are twice what they were in 1991. And that, as a side note, is why leverage is a good thing when there's inflation, because you've got a debt that's static, yet you've got an asset value and your income stream, the rent, which are rising somewhere in line with inflation. Therefore, happy days for you as the investor. So some of the house price growth can be put down to inflation. So I think if you're doubling every 10 years, my maths isn't the strongest, but I think that means that annual growth is something in the region of 7%, and then it compounds and gets you to 100. So some of that is inflation and some of that is actual growth over and above inflation. And according to the Halifax, since 1959, real annual house price growth, so that's over and above inflation, has averaged 2.7%. So on average, again, house prices are growing faster than prices in the general economy by 2.7%. So you add those two things together, you've got the inflation, you've got the supply and demand. I'm sure there's other factors as well, but those are the big ones. And that is why the price of housing has gone up historically. So we've been looking all the way back to the 50s. So the big question really is this going to keep happening? You can look at history as a kind of a guide to what might happen in the future, but of course you don't want to make the mistake of thinking that just because something has been true in the past, it's going to be true in the future. Because, things change. The world that we live in now is very different from the world that we've lived in the past. So that's what we're going to get into in the meat of this episode. So there are reasons why it might keep happening and there are reasons why it might not. So let's start with the bullish case. Let's talk about why this doubling of prices might keep happening.
Well, we've mentioned it a lot this episode already, and we've done a podcast on it 2 weeks ago. But the continuation of the supply and demand issue will continue over the long term to push prices up. If we don't solve that, then over the long term, property prices will continue to double. Now, at what rate is debatable, but eventually they will, because we can't solve that. The other reason why is the availability of credit. Banks want to lend. That's how they make money. They don't really care about savers. Well, they do, because they have savers' money and then they're able to lend, and that's when they make the real money. If banks exist, then they'll lend. If people lend, then property prices will continue to move forward. Low interest rates. Not going to last forever, but they've lasted for a while now, longer than most people have predicted. But people are now commentating and speculating that rate rises might not even start till 2020, or at least a year or two away. Nobody's saying in the next 6 months or the next year. Everyone's going medium term. So low interest rates are here to stay for a while, and how long they'll stay low for once they start to rise, it's probably going to be a significant amount of time. And many other parts of the country are still very affordable. It's interesting, at the meetup last night, I was speaking to someone and he said, it's just crazy how property prices have gone and it can't be sustained. And then I pointed out, you're very much in the bubble of the southeast and everything you know property-wise is here. But I said, you move up north and property prices haven't moved. And you can get a starter home for 100k. And if the average wage is roughly 20k per person up there and a couple buys a property, well then what they need as a deposit, 5k, is not a lot. And it's actually really, really affordable. So people are influenced by their local areas, but there are many parts of the country where it is still very affordable. So multiple reasons there, but the big one is obviously supply and demand. But, of course, to be balanced, we have to put an argument together to say, well, why might it not continue?
Yeah, because you do have to be careful. You will go to one of these kind of pitch fest free education days where they upsell you to the expensive course, and you've always got the bloke on stage at the front sort of talking about how property prices double every 10 years, making it sound like it's a dead cert that it's going to happen again. But of course, it's not a dead cert. There's lots of good reasons why it could, and it might, but there's also reasons why it might not. Firstly, house prices can't grow faster than incomes forever. It does get to a point where it's unaffordable. And when you get to that point, if house prices keep rising faster than incomes, it gets to a point where people can't afford to buy a house. When it gets to that point, then you have to ease affordability. So maybe you offer higher multiples of income. Maybe you extend the mortgage term to reduce the monthly payments. And all these things have happened. But at some point, that too becomes unaffordable. So what do you do then? And I think this, again, is where you have to look at it regionally, because I'd say that in London, basically, it's already kind of at the limit of what people can afford. But elsewhere in the UK, as Rob has just said, price to earnings ratios aren't that bad. There's many parts of the country where that's the case. So I don't think this is a UK-wide concern right now, but it's still very much a factor. Another factor is inflation. So I was talking about inflation earlier. And if you look at real house price growth since the 1950s, it's averaged 2.7% per year. So the rest of that has come from inflation. Therefore, if we're in a low inflation environment, then house price growth won't be as strong as it has been in the past. Now, that's kind of irrelevant, because if house prices are doubling because everything else is doubling as well, then there's not really any point to it. You're not sort of going, wow, what a blinding investment. But it is nevertheless a reason why house price growth might not look as spectacular in the next 10 years if we are in a low inflation environment. Also, if that's the case, it makes leverage less attractive, which is the flip side of what I was talking about earlier. And a third reason, I kind of hinted at the fact, and it's not a great secret that we are bearish on London, and I sort of hinted at the fact that affordability was stretched in London compared to elsewhere. It's potentially the case that if London reaches the point where it gets too far, the bubble bursts and everything drops, then that might ripple out and affect everything else because of sentiment, really, more than anything else. So even though other parts of the country are much more affordable, London, because everything's so centralised, does tend to ripple out and have an effect on everything else. One kind of indicator of this is that if you look at prime central London, almost half of all properties that were sold in the first quarter of this year had their asking price reduced before a sale was agreed. Now, the same time last year, it was 40% rather than 50%. And 2 years ago, it was 27%. So that seems to be an indicator that people in prime central London are having to cut their prices or lower their expectations from what they thought they could get. That could ripple out and affect everywhere else. So it's a factor. Again, though, it's only a relatively short-term factor. And we are talking about the next 10 years. 10 years is a relatively long time. So even if you get a wobble for a couple of years, that doesn't mean that people are still going to be thinking about that in 10 years' time. So we've had a few reasons why property prices may well keep doubling, and we've had a few reasons why they might not. And this has been hopefully an interesting and a useful discussion, but it has missed a couple of key points.
So the first one is growth spurts. So the property cycle tells us that the rate of growth isn't constant. You just have to look at the data. It's not a steady line upwards, property prices. It's a wave. It's a wave upwards, but it's a wave. Even if property did double exactly every 10 years, it doesn't mean that it's going to go up that same rate, as I've said. So that would be 7%. There are clearly times when property prices are falling, 08, and there are times when it's going crazy, 05. And then we see it average out to something like a 10-year, 9-year, 11-year average, wherever it may be. But what you can do is you can use the cycle to time your purchases and disposals to benefit from the times of the most growth. I think this is the key to this article, and we're going to come to some summaries and some conclusions shortly. But as an investor, this is the most important point to know and understand. If you've seen the doubling already, don't assume that it's going to double again more quickly than all the other areas. Equally, if you're in an area or investing in an area that hasn't moved at all yet, don't think, well, this area is screwed. It's not going to move at all. I need to get into some of these growth areas. If you just buy or hold, by knowing the cycle, you won't be surprised when your properties do well, and you won't be surprised when they're not doing well. If you buy in the areas and buy strategically where you think growth is going to happen because you can see the cycle, see what's happened, looked into the data, then there's a real opportunity here. You know when to expect a slow point and you know when to expect a growth point. But that's the beauty of the cycle, and that's what makes it really interesting. If it's a constant, it'd be dull. Well, this would be a rubbish episode. But because it's not, and because people are very much affected by the growth spurts, that's what makes property interesting, but also the opportunities arise.
Yeah, exactly. I think that is a really, really critical point. No surprise there. We've talked about the cycle a fair bit in the past, but I think rightly so, because it is massively important. The other thing which we have talked about, but I think it's worth mentioning again because it is critical, that when you look at the UK average prices, that conceals all the regional differences. And that's why if you just buy any old random property anywhere and expect it to double in 10 years, there's a high probability that you're going to be disappointed. There are parts of the UK where prices have doubled since 2006. There are other parts of the country where prices are lower than they were in 2006. And there's a link that I'll throw into the show notes, which is really interesting, from the Office of National Statistics, that shows what prices have done in different regions of the UK since 2008 and 2015. And you can see, if you look at the UK as a whole, prices now are higher than what they were then. But then you can look at the other regions and you can see that in some of them, like Northern Ireland, prices have gone completely the other way. In other places, like the Northwest and Wales, it's practically flat. And the differences are absolutely huge between different parts of the country. And that is still quite a broad level. That's before you get into talking about micro-location areas, like, not even cities. You'll get down from regional level to city level to areas within city level, and then different types of property within those cities. There's all these different things. And so talking about UK house prices, it's kind of interesting to speculate, but it's not all that helpful because you do not own the average UK house. It's not possible. You own a specific portfolio. So the decisions that you make about that portfolio can't be driven by macro stuff. It can be partially, but it can't only be. You can't just buy, as I said, any old random house anywhere and expect it to double in 10 years, because there are all these huge, huge differences. And that's why discussions like this are interesting and useful to an extent, but it's far from being the whole picture.
So what can you conclude from this? What can you take away and what can you use from this episode? Well, I think the big one is, as we mentioned already, it's timing. Will property double in the next 10 years? said this last week, yes and no. In some areas, it will double in the next 10 years. I'm certain. It will. There's that many places in the UK it's going to happen. And equally, I'm certain that places won't. Even if we go into an aggressive growth spurt now, not all areas will double. Now, let's take Yorkshire as an example. Roughly, prices are, in some areas, the same as 2008, in some areas slightly below. I think areas like that will do very, very well over the next 10 years and stand a very good chance of doubling. So, wow, that's great. Let's get into places like Yorkshire. But if you bought at the peak last time round, 2008, you've waited a long, long time, far longer than 10 years for it to double. So timing is what's key here. And as I mentioned before, following on a trend of somewhere that's grown really aggressively and doubled already recently is probably not the best tactic. Looking for value and fundamentals will help you get the next part of the curve. And the resource of the week from last week will help you analyze those areas with value so you can look and say, okay, the second half of this cycle, I could do well. And then this comes to a deeper point, and it comes to the timings, the lengths of these cycles. And I've got a prediction. The longest cycle we've had so far on record is 14 years. So the longest time it's taken average UK prices to double has been 14 years. I think we'll break that. I think we'll break that this time. I think it could be 15, even 16 years before we see property prices double. So nearly the whole of the 18-year property cycle, 16 years of it, it will take for some of those property prices to double again. And then, unfortunately, the UK market will correct a couple of years later. I'll also make another prediction. I'm setting myself up today. I don't think the next crash in around 2025, and give it a couple of years either side, will be anywhere near as aggressive as what we've had last time. And I relate back to a video highly recommended on a few occasions now, How the Economic Machine Works by Ray Dalio. We'll link to it in the show notes. An absolutely fascinating video, and it really, really does a great job of explaining how the economic model works in the world. But essentially, the crash that we had in 2008 is a once-in-a-generation crash. We had it before, but again, it was a generation ago. Now, what's interesting is after that last crash, you had cycles again. Now, each cycle, to begin with, wasn't as aggressive after the crash. So let's look at it. So the last major crash in 1929, the Great Depression, the cycles after that, and this very much relates to the Ray Dalio video, so watch that and then relate it back to this, were not as aggressive straight after that crash. There were still cycles, but nowhere near as aggressive. And they got generally, roughly, more and more aggressive as we got to the top. Now, you could argue the 70s cycle was more aggressive than the 80s because property doubled a lot faster in the 70s. However, that was very much driven by inflation. A non-inflation cycle and boom and bust, the 80s was actually the second biggest one. And lo and behold, 18 years later, we had the biggest one and the generational massive crash. Now, this time, we're going to go start cycling again. And I don't think the crashes will be anywhere near aggressive in the next few cycles, but equally, the growth won't be as aggressive as well. And I think that's why we'll have the longer time frame for property prices on average to double in the UK. And it's interesting, I was speaking to someone, Taylor Wimpey, recently, and he said how they've learned a lot of lessons from the last crash, and they're not buying land at the moment with a lot of debt. In fact, he said most of the land they buy now is their own cash, whereas before the crash, they got into a lot of hot water and a lot of trouble and came close to getting in some serious trouble because they'd used finance to accelerate their growth. But the other thing to remember is the people who are now in the city, who are now moving up the ladder in these companies, the Taylor Wimpeys of the world, the banks of the world, a lot of them weren't working in 2008. And this is where the economic memory comes in. And there'll still be, the economic memory of 2008 will still be fairly raw by the next crash. And that's why it won't be as aggressive. But then moving forward through cycles again in the future, they'll just get slightly worse. The booms will get slightly bigger as that memory fades. And actually, it's not just the people in work that don't remember the last crash. It's a whole generation. And then we cycle round again. Now, I know I'm talking about 70 years before our next major boom and bust. And I'm sorry if you're not going to be in the game then. But I think it's really interesting. And of course, it's all theory. But if you watch the video and then listen back to what I've just said, hopefully it'll make a lot of sense.
Well, sticking your neck out today, Rob. There's some. You're gonna have to. Well, I think you're safe because you have to listen to episode 700 or so to see if you're right or not. But there's some big predictions in there, and it is a really interesting video, the one that you refer to. So if you haven't watched that, do go and check it out. But I think if we could pull this round to some kind of summary, I think one thing that we can be sure about is that whatever happens over the next 10 years, it won't happen everywhere equally. I think we've seen that in the past. And it seems really obvious, but I think it gets overlooked so often and it can lead to people making bad decisions. And it looks likely to me that the north-south divide that's opened up so massively is likely to narrow, have a bit of mean reversion, and you'll have the strongest growth in the north. But that's just conjecture. But I think we can be sure that whatever happens, it won't have happen everywhere equally. And I think it's also important, and Rob, you touched on this, that it's still very interesting. And it is interesting. It is important to have a view on what's going to happen more broadly in the future, but it's not the whole picture. And whatever you believe to be true, it is conjecture. And so I think you should really try to make your money when you buy rather than relying on the market to do the work for you. If you buy, like I said earlier, just any old house at today's market value and think, brilliant, job done, it'll be worth twice as much in 10 years, very high probability you'll be disappointed. And it sounds silly. It sounds silly that people do that, but people do that all the time. So if you want to perform as well as you possibly can, not everyone does. Some people do just want to buy something as a place to store money or as a pension or whatever. But if you really want to do as well as you possibly can, maximize your results, build a portfolio, then you should really, rather than just kind of going, well, let's just buy and wait and hope for the best. There's so much that you can do that if things do go your way and the market lifts the values for you, then you'll do doubly as well. And if the market isn't so kind, you'll still be okay because you either bought at a great price or you added value, or you're making sure that whatever happens, you'll do pretty well. Then if the market's kind, you'll do really well. The danger is that you're gambling on the market. You get your timing wrong, you get your area wrong or whatever. And then you end up getting into some serious trouble, which has happened many times before. Lots of people in 2006 were thinking that everything was going to double again in the next 10 years, and it was all a surefire thing. They were buying off plan because by the time it was complete, it was going to be worth so much more. We've seen this before. So I think it's a two-parter. Important to know the theory and to understand the economics, but also important to build the knowledge, build the skill set, and to be an effective investor, whatever the market throws at you.
I think that's summed up nicely, Rob. It's definitely a combo of the two. Understand what's happening, but don't be lazy. Continue to buy well. Don't just go, well, I understand what's happening, so I'm just going to buy anything in this area. You might have got it wrong. So if you buy well, you're protected. But if you're right and you've bought well, cha-ching, you're going to do very well. I told you there was going to be a lot of enthusiasm for this episode. I think my coffee's good this morning, so hopefully you've enjoyed that. But before we get to the resource of the week, which I know a lot of people have enjoyed, and tell you what we've got coming up next week, something else we really enjoy, Rob, are reviews.
We absolutely do. We've had a lot of them, but we're always up for more. And this week, I'm sure we're not going to be disappointed, are we?
Oh, no. Thanks to Robbo, great name, 5 stars. Both the Robs are brilliant at producing digestible information, which is fun to listen to, informative and motivational. In the way they portray the information means that everything is in bite-sized chunks and there is no overload of information. Fantastic stuff. Keep up the great work. Well, thank you, Robbo. Thank you for your 5 stars.
Yes, thank you very much. And in return for your 5 stars, we'll give you a resource of the week. And thank you to Matt for this one, who sent this one in. It is called switchboardfree.co.uk, switchboard free. We've mentioned a couple of these before. It's like kind of virtual call answering services. We've done at least one of them as a resource of the week in the past, but this is another one that seems to have, again, I haven't tested it out, but Matt has, and it seems to have loads of really great features, Also, there are certain numbers that you can get completely free. So if you don't want a geographical number, but you're happy to have like an 08 number, then you can have those completely free. And I think it means there'll be a cost for the people who are calling you. But there's loads of cool features. And it basically means that if you are trying to balance property investment alongside work, or indeed just having a life, and you don't want your mobile to be ringing all the time with with tenants or tradespeople, agents or whatever wanting things, you can do some cool stuff to make sure that those numbers get routed appropriately, that there are voicemails, and that you don't get bothered all the time. It just makes a really easy way of making your investing life more efficient. So well worth checking out.
So this episode was the end of a three-parter. We've been looking at big picture economic models and how it affects property, and hopefully you found it interesting. We've really enjoyed it doing it. But next week we're going to get down and dirty with some actionable tips that you can use, and we're going to look at HMO hacks. So what can you do to run a HMO portfolio more efficiently? Because let's face it, HMOs, the reason why so many people are attracted to them is because of the higher returns. But equally, the reason why so many people stop after one or don't start at all is because they seem like a lot of effort. And they certainly can be. So next week, we're going to look at hacks you can use, you can take to make running a HMO portfolio that little bit easier.
Yep, it'll be a nice change of pace from the last few weeks. I think there's going to be loads of really good stuff in there. So we hope you will join us for that one. Thank you for listening today. The show notes, there are again, loads and loads of links. All of them are going to be at the show notes, which are at thepropertyhub.net/next10years. We'll be back again next week. We'll be back before that with Ask Rob and Rob on Tuesday. Thank you again for listening. We'll see you very soon. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.